What's up everyone, it's Caddy with Money Investing. So I've got a jam-packed update for you in this video. We're going to talk everything about the economy. We're going to talk a little bit about the markets, the yields, the technicals. Everything is going to be covered in this video. So make sure that you drop a like and don't forget to subscribe to the channel. If you're just joining us for the first time, and the link to our Discord and Patreon is going to be down below. It is the first week of the month, so March is here. I'll also break down some of the seasonality trends in this video, but don't forget to check out the Discord and the Patreon links down below. You'll get access to all the trade ideas, alerts, all the buy and sell alerts, options alerts, and of course the private videos and a lot of Discord channels also part of that as well. There's over 3,600 members talking about pretty much fundamental and technical analysis all day long. Tesla's Investor Day, Master Plan 3, in my opinion, didn't quite live up to the expectations. There was a lot of speculation, a lot of expectations. Instead, the event fell short of a lot of announcements, unfortunately. And because of that, Tesla was down a little bit over 5% after hours. The calls that I have right now, they're sold calls. In other words, they're covered calls. They're a hedge against potential downside. Should be up at least up over 60 to 65% in profit tomorrow once the market opens. So this right here are calls that we pretty much sold earlier last month, and right now they're up 53%. And I'm hoping that after tomorrow's sell-off in Tesla, considering that it would be down or pretty much gapping down or opening in a little bit over 5%, considering even higher sell-off down in the sub 190s or even lower than 185. These calls should be up another 70 to 75%. I'm looking for at least 85 to 90% profit in this scenario. So I'm definitely looking for more potential downside in Tesla. No offense, but of course I'm expecting downside here in Tesla, right? That's how these calls will hedge. And again, if you want to access all these options alerts and find out exactly what I'm trading, when I'm trading, the links are going to be down below. And we are going to be starting a real strategy in April of 2023. I think that's going to be super helpful, super beneficial to those people that are just getting started with options trading and want to generate some passive income on the side. And we're going to go over step by step, the whole process, the whole tutorials, everything is going to be discussed. But moving forward, this right here is something that I mentioned in our Discord today. Woke up this morning, still sleepy. First thing I checked were the yields. And I literally, and this is true story, literally fell off my bed looking at the 5-year yield and then realized I'm looking at the 1-year and not the 10-year. There's a mini heart attack right there, because when I looked at this 5.1, I was like, no way, what happened in the markets? And I was like, oh, wait a minute, I'm looking at the 1-year and not the 10-year. But the 10-year didn't look pretty either. It was trading at over 4%. You can see that right over here, 4.008%. It's a pretty substantial number for the 10-year yield, because we're once again crossing past 4% yield, right? Which is again going to put some additional pressure on equities. And this number has more meaning than a lot of numbers out there, compared to a lot of numbers, because it's probably going to deserve like a whole separate video in itself, because when the yields climb up, valuations get dropped because of the higher discount rate. Because now you're having to fight against the 10-year yields. Think about that for a second. If 1-year yield is 5.1%, we've got the 10-year at 4%, 6-month as at over 5%, equities become less and less attractive, right? That's just law of the economics, right? Equity risk premium. That's how it is, right? People are going to gravitate more towards where they find the best opportunity, best reward for the amount of risk they're taking on. And with the 10-year yield, with the 1-year yield, with the 6-month yield, there's no risk. It's backed by the US government. So you're able to generate that yield risk-free. Hence why they're called risk-free rates. And that's why equities become less and less attractive, less and less incentivized to be pretty much holding on to them, because the equity risk premium is dropping. And the reason why interest rates are rising right now is because we also got a big flip on the Fed funds futures. We'll talk about that in just a minute. And it's really because the inflation expectations are anchored a little bit higher. Tom Lee also mentioned this specific phenomenon that a lot of people are talking about ERPs, because they're getting lowered. And right now we're sitting at 1.5%, might even be lower, might be 1.3, 1.2% now, considering the dividend yield on the S&P 500, considering the earnings yield on the S&P 500 subtracted by the 10-year yield. So There's inflation anchored. That's one element of it, but it's there for a reason, right? Markets are expecting inflation to be a little bit higher, and as a result, rates to be higher for longer. This right here was the PMI manufacturing final number, and this is one of the reasons we actually did get a little bit of a rate cut priced in for some reason in the Fed funds future. I'll go over that in just a minute, but PMI manufacturing numbers came in at 47.3. We actually got a pretty much a lower number. Consensus was 47.8, so we came in a little bit shy of the expectations, and anything under 50 tells us a little bit about contraction in the economy. Same with ISM manufacturing index, came in at 47.7, so a little bit soft of the consensus of 48. So once again, anything under 50 tells us a little bit about a contraction in the economy. Construction spending also pulled back month over month, down 0.1%. Versus consensus, which was an expansion of 0.2%. So both of these numbers, all three of these numbers, pretty much suggesting that the economy certainly is showing signs of some deterioration. We have been seeing that for some time, but labor market remains tight. Economy is still growing despite some of these other indicators that we're looking at. So it's gonna take some time for the wheels to finally be turning. I have full faith in the U.S. economy that we are potentially going to enter a recession, and I'm saying that from a more objective, more humorous way. I don't obviously want the U.S. economy to enter a recession, but that's something that will eventually happen, in my opinion. There's no doubt about it, considering all the things that I'm looking at, all the indicators with the inversion of the yield curve, with the consumer spending, with the excess savings. The savings rate has been dropping lower, so around middle of this year is when the consumer is also expected to run out of their excess savings, and then we'll have to tap into even higher debt levels, and then not to mention that the inversion of the yield curve, the higher interest rates, lower construction spend, lower PMI manufacturing numbers, retail sales is going to be a big indicator for consumer spending and how they're holding up as well. All those things may not make sense now, but once you connect those dots in the future, maybe 6 months down the road, it will become more apparent, when it comes to those numbers, right? When it comes to a potential recession reading. This right here is the current most up-to-date meeting probabilities for the Fed funds futures. And what you'll notice here is that a couple different observations. Number one, markets now pricing in not a 75, but a full 100 basis point hike. That's pretty crazy, right? 100 basis point hike. So we're going from like 4.5% all the way up to 5.75%. Earlier, it was about 75 basis points, right? For us to go up to just as much as 5.25 to 5.5%. That was the expectation, right? The terminal rate was sitting at 5.49%, but now the terminal rate is going to be sitting somewhere between 5.5 and 5.75%. That's the big change, number one. Change number two is the likelihood of a 6% terminal rate is increasing. Now we're sitting at almost 15%. And this number's climbed for under 3%, right? We talked about this just a couple weeks ago. I brought this up, and there was not a lot of attention being paid to this number because it was really, really low, right? And even in the comments, people said, Caddy, why are we focusing on this when it's not really that big of a deal? Well, guess what? Now it's almost at 15%. If the numbers keep coming in hotter than what we expect them to be, like in other words, if you start to see inflation once again trending in the wrong direction, if you see that counter trend in inflation, these numbers will push higher because the Federal Reserve, let me break it to you if you don't know this already, the truth is the Federal Reserve couldn't care less about the economy. They don't. They care about inflation. That's what they care about. Despite what you may hear, despite what you may know, the Federal Reserve, Jerome Powell, do not care about jobs, do not care about the economy. They care about inflation. If inflation doesn't come back down to 2%, they are going to go all in, hot and heavy, to still keep bringing rates higher. The terminal rate's going to go higher despite what the market keeps pricing in wrongfully, right? Incorrectly, all of 2022, the market's priced in a cut, a pivot, a pause. Neither has come. Why? Because Jerome Powell has made himself clear, and they've got a point to prove. They've got a message to send to Washington that they are doing their job, and that's what they're going to do. They're going to keep raising rates as much as they can, as hard as they can, for as long as they want, to make sure that inflation comes down, even if that comes at a cost of breaking the economy. So right now, 6%, there's a 14% probability, 15% probability. I think that's only going higher if if the Federal Reserve continues to be as hawkish as we've seen them, and if the inflation readings continue to come in super, super hot. So Tesla stock falls more than 5%. We talked about this. Again, I will be doing a more separate, more dedicated video on Tesla, but we did see a pullback on Nvidia down 2.2%, Tesla 1.5%, Amazon was down, Microsoft, Apple. Most of tech and big tech was selling off. Energy was holding up pretty well. So again, energy, basic materials, they were some of the sectors that were pushing higher, and some of the other technology here, financials, healthcare, utilities, consumer defensives, all of them selling off. And basic materials, energy, the two leading sectors here on the day. Everything else was straight up down. Over the last 1 month, we've got pretty much all sectors in the red except for industrials and technology. And over the last 1 week, we've got energy and basic materials are the only two sectors pushing higher. Everything else is straight up down. Sugar prices, cocoa and cotton, VIX pushing higher. With orange juice definitely selling off quite a bit, with lumber prices pulling back and ethanol and coffee also pulling back. In some of the individual industries, solar, aluminum, cooking coal, whatever that is, other industrial metals in mining and copper and oil and gas pushing higher, uranium. A lot of the metals, you'll notice a lot of the metals were pushing higher, but we did have some of the utilities and consumer defensive companies selling off, which again is quite interesting considering where we are headed with the overall economy. Bitcoin here just once again selling off, trading a little bit over 23,000, and Ethereum was just over 1,600. Now, in terms of advancers and decliners, S&P 500 had over 316 stocks declining, with 178 stocks pushing higher. In the NASDAQ 100, that ratio was about 70-30. 70 stocks were going down, declining, and 31 stocks were pushing higher. And in the NASDAQ as a whole, over 1,900 stocks pulling down, and 1,453 to be precise, pushing higher. This right here is the NASDAQ composite stocks trading above or below their 200-day simple moving average. So we didn't quite see us get up to over 72%. I mean, we hit a high of 71 point something percent, almost as up to 72%. But looking at historical measures like 2021 and even from before, you'll notice that we actually got up to this level from back in 2019. 2020, so to speak, from back in March before this sell-off actually happened. And now we're starting to see a bit of a pullback once again. But we didn't quite get up to those extreme levels of euphoria of 92, 93% of stocks in the NASDAQ trading above their 200-day simple moving average. This right here is also something that we talked about in our previous videos. This is all percentage of stocks trading above their 200-day moving average. All of them, right? All of them in the markets, whether it's S&P, Dow, NASDAQ, whatever it is, all stocks. And again, we didn't quite get up to as much as 80 to 90%. You know, this is where we have really seen the markets kind of tap into and then start pulling back. But instead, this time around, we pretty much started dropping right after hitting close to 66, 65%. And now we're seeing a bit of a pullback. Now, this right here is going to be that seasonality trend for the month of March, because March has started. So what you'll notice is that out of these 70 plus years that we go back to, I think this data goes back to 1950s. So 46 years have been up years and 27 have been down years, with an average return of just under 1%. Of course, 2020 was brutal, over 13% down. So we are also coming in close with a 3-year anniversary of the COVID crash. So March 2020, time flies. I know, right? 2020 March was the time when markets pretty much sold off. And in the last 3 years, there's so much that's happened. So much that's happened in the markets and in the economy, in the world of business. But we are coming in close with that 3-year anniversary. But overall speaking, March is supposed to be a good month from a seasonality standpoint. We'll see what that ends up looking like, considering that February was down. So NASDAQ here down 66 basis points, 11,300. We got the S&P also selling off here quite a bit, 0.5% on the day. And then we got the 10-year yields once again pushing through past 4%, and got the Dow Jones slightly flat. So Dow stocks kind of held up a little bit better as opposed to tech stocks. And that makes a lot of sense because the 10-year yields were pushing higher, putting in additional pressure on equities over in the speculative growth and tech sectors. Talking a little bit about the volatility, slightly lower, 0.5%, but still trading a little bit over 20.5. Next resistance is going to be staying put at 23, close to 24 levels for the volatility. And we've also got crude oil sitting at just a little bit over $77 per barrel. So we are once again seeing a lot of consolidation for crude oil in that range, and we just continue to trade sideways between low 70s and low 80s, and it's just been going back and forth in that target range. When it comes to Bitcoin, we are seeing a lot of consolidation once again, of a little bit of rejection at 25,000, and same thing with Ethereum, where we are seeing a little bit of resistance there at 1700. We're not able to successfully break out past this level right now for Ethereum. Now, going over to the S&P 500, unfortunately, we are now starting to break apart from that 200 simple moving average. So, in fact, we're actually right there. We haven't broken down, but instead we got a perfect retest. So this is about as important as it gets, folks, because we did get a validation here at that 200 SMA. But take a look at this string of red candles, right? 1, 2, 3, 4, 5, 6, 7. 7 consistent red candles. 7 straight days, the bears have done their job in making sure the markets, or S&P 500 specifically, closes at a lower level than where it opened. Doesn't matter whether we were higher or lower on the day. What matters is the intraday sentiment, the momentum, who has the upper hand in this price action battle. And right now, unfortunately, it is the bears. Futures are not looking pretty. We've got the NASDAQ futures down 0.5%, S&P futures down 38%, but that 200 SMA, very, very important level to watch, in roughly at 39.40. Talking about the NASDAQ, we're already starting to break below that 200 simple moving average, which doesn't look good, obviously, because we are now breaking below that very, very important support. And at the same time, that next support is going to be sitting put at 11,200 to as low as, of course, low 10,000. If this selling pressure, selling, what we're seeing here, accelerated selling, continues to catch momentum and we drift even lower. So if you get a breakdown here below this lower high, next support is going to be in the low 10,000s for the NASDAQ. Talking about Apple, and Apple here continues to sell off, pulls back another 1.4%, does not come as a surprise. We were talking about RSI, MACD being a little bit overextended, fighting that resistance for some time for Apple here in the 150s. And right now we're seeing a little bit of a pullback from those levels and starting to roll over once again for Apple. So next support really is going to be at 137 for us to watch for Apple moving forward. Talking about Amazon, Amazon's kind of validating that support really well at $91, $92. Now, this can be seen as a potential opportunity for a swing trade, but a much better entry, at least in my opinion, would once again be closer to $81. So this right here would be that level to watch for Amazon as a support, because we have, validated that level really well, had a very nice rally from those levels. Amazon pushed up 40% after testing lows of $81 per share. So this right here, if you are creating a potential swing trading idea, just make sure that you have a proper stop loss in place in case Amazon breaks down below 91. And then the next re-entry, that next area for us to go long would be at closer to $81, $82 per share for Amazon. Talking about Tesla, and Tesla after hours, unfortunately down quite a bit, over 5.6%. Still in the context of this bull flag, so we still have a potential consolidation here going sideways. But everything that I've heard about Tesla's Master Plan 3 was not like super exciting. Like, it didn't really get me excited about, the company or the stock. I mean, obviously the company itself is doing great. So the expectations were hyped up, and this again kind of becomes that buy the rumor, sell the news type situation. And even in recent events, Tesla has sold off after the battery day, the AI day, the investor shareholder meeting. I mean, lots of things, they've been just hyped up, and the actual event has a little bit, hint of under delivering what they promised. But that being said, I wouldn't be surprised if Tesla consolidates a little bit sideways at this levels at 190s. But if you do continue to sell off here, then really, really important levels watching at close to 166, in line with that 300 simple moving average. And we got the 200 SMA sitting at just under 160 for Tesla. Talking about PayPal on the day, up a little bit over 30 basis points. Lots of consolidation for PayPal at that support here. We still have a gap to fill on the downside, so we're just trading sideways. Resistance is going to stay put at $75, so this right here is going to be that level to watch for PayPal. And of course, support level is going to stay put at $67, at which point I do think there is going to be a potential opportunity for a swing trade on the long side for PayPal at those levels. Talking about Square, and Square also just consolidating sideways. We're mostly trading inside this downtrending channel of lower highs and lower lows. So right now, That's going to be that level to watch. And we got a next support sitting all the way down to $69.75, a little bit under $70 per share. And Square also, I'm really interested in potentially, even investing in this company long term or taking a swing trade on this, but at lower levels. I'm looking at, $50 to $59 as a potential entry for Square. So definitely keeping that on my watch list for a trade idea in the future. Talking about Nvidia on the day selling off a little bit, down now under 230. So we're starting to fill this gap little by little, down 2.2% on the day. Once again, the RSI MACD just doesn't make sense. The valuation doesn't make sense. So I'm super cautious with this company right now. I don't think I have any Nvidia, maybe a little bit left. We'll probably be selling that off for a small profit, or we'll be looking at dollar cost averaging opportunities at much, much lower prices for Nvidia than compared to where it's trading right now. So this will be turned into a resistance at 230, and support level is going to stay put around 189, close to $190 per share for Nvidia. AMD with a very, very flat day, slightly down 37 basis points, still getting a big rejection here at that 200 simple moving average, kind of in line with $78, $79. So that is something to pay attention to. And support level next is going to stay put at $71, $72 per share. Also, we've got a gap to fill for AMD over here. So there's going to be a potential opportunity for AMD to come down, fill this gap. I also have covered calls on AMD sitting roughly at around $85 per share, if I'm not mistaken. I think that's where we are. And those calls are still out of the money. So they are up close to 60, 70%. I will be looking to close them out very, very soon. Talking a little bit about Meta platforms, and Meta here was slightly lower, 87 basis points. So once again, lots of consolidation, not really moving all that much, but resistance is going to stay put at that 300 SMA, sitting roughly at 181. And we've also got a support staying put at roughly around 168. And also we've got this gap that we need to fill for Meta eventually. So next support all the way down to 154, also in line with that 200 simple moving average. Meta does have a good value here, 14 times earnings and a little bit under 5 times sales. Not really that bad, trading at decent valuations, but it can certainly get better. Talking about Netflix, and Netflix here continues to fall off, down under 2.6%, rightly so, because the valuations are a little too high. Technicals didn't quite make sense considering how overbought it was. So the next support really is going to be down to 275, 276. So this right here is going to be that next level to watch, all the way down to low 250s for Netflix moving forward. And resistance is going to stay put at 330 to as much as 370 for Netflix. Talking about Google here, and Google getting a little bit of a bounce back up to over $90.51. So nothing crazy, but it's definitely oversold. Both the RSI, MACD valuations are reasonable. So I do think that Google has an opportunity to at least retrace back up. If the market cooperates, it has the opportunity to retrace back up to at least $100. That's going to be some decent upside of close to 10 to 11% for Google. And last but not least, we got Microsoft and Shopify. Microsoft here continues to drop off another 1.26%, breaking down below the support of 247. And the next support really is going to be down to $218. That's exactly where we have bounced off of 3 out of the 3 times in the past. But my fair value obviously is going to be staying put at low 200s. And last but not least, we got Shopify. And Shopify, once again, getting a big rejection here at $41, $42. So this right here is going to be that resistance level to watch for Shopify. And right now, a little bit oversold, but next support really is going to be staying put at $29, close to $30 per share for Shopify. And that's where I would be very much interested in a potential swing trading opportunity for Shopify as well. And we'll share that idea with all the members. So hope you guys enjoyed this video and a complete update. And the bottom line is the markets are indecisive, very, very uncertain with the macro environment. And we still have a lot of data points to look into, but the Fed funds future is definitely now pricing in a full 100 basis point hike. And the probability for us to get up to 6% is only increasing with the 10-year yields crossing past 4%. And the market's still holding up pretty well. That just goes to show how strong the sentiment is. But the reality of the situation, unfortunately, is that I think we may have more downside than what we actually believe. As always, happy investing. Make sure that you check out the Discord and the Patreon links down below. It's the first week of the month, the best time to join with limited spots available. As always, happy investing, and I'll see you all in the next video.